Billionaires bypass income tax by borrowing against their real estate and stock portfolios to fund their lifestyles. You can replicate this playbook using 0% credit card arbitrage and commercial trade lines to acquire your own assets. Wealthy individuals building massive generational fortunes use a single mathematical figure to separate themselves from ordinary people drowning in endless high-interest financial obligations. The total principal size of the loan fails to explain this massive financial divide. The specific annual interest rate attached to the legal contract fails to explain the final financial outcome. Two separate buyers secure identical funding to purchase identical income-producing assets at matching percentage rates on the exact same morning. One buyer mismanages the asset and becomes bankrupt. The other buyer optimizes the asset and builds massive personal wealth exceeding their starting net worth. Buyers experience opposite financial outcomes from identical borrowing terms because of one specific mathematical calculation. You will calculate this exact metric for your own personal finances to determine your true borrowing power. Individuals ruin their personal finances when they treat leveraged capital like a poor person consuming depreciating liabilities. We must define a commercial loan as renting money. Financial institutions rent you cash to fund your investments. You take a specific sum, pay a fee for the duration, and return the principal amount at maturity. The stated interest rate functions as your monthly rent. Your primary objective involves deploying that rented cash to purchase productive assets, generating returns exceeding the rental fee. Borrowing funds at a 4% annual rate to purchase an asset, generating a 7% annual yield, leaves you with a 3% profit on capital belonging to the bank. Financial professionals call this specific profit margin the spread. You dictate your entire wealth-building strategy by maximizing this positive margin. Your personal return on equity equals the spread multiplied by your specific leverage ratio. Leverage measures the total borrowed dollars you control for every single personal dollar invested in the deal. You discover your exact return on personal cash by multiplying the profit margin by your leverage ratio. Wealthy investors evaluate funding opportunities by calculating the profit margin and determining the total capital they can control with minimal personal risk. Average borrowers obsess over rapid repayment schedules to eliminate their monthly debt obligations at maximum speed. You and a millionaire look at the exact same legal contract and ask different strategic questions. Every single financial strategy presented next applies this exact mathematical equation using unique variables tailored to specific asset classes. You possess the current capital to execute a few of these 6 methods using your existing bank accounts. Other methods require significant future wealth accumulation before you can qualify for the necessary funding. Complex billionaire tax strategies remain impossible to execute on a random Tuesday afternoon without a dedicated team of corporate lawyers and accountants. You clarify the underlying mechanics behind the smaller personal strategies you can implement during your free time by understanding the massive institutional applications. You can trace the oldest commercial strategy back to trade credit, a practice most product businesses on Earth use to survive. Imagine you decide to sell basic ballpoint pens. Retail buyers maintain a steady demand for them. Traditional business classes teach you to fly to a manufacturing plant, hand over your personal savings for a shipping container full of inventory, transport the goods across the ocean, and sell them to stores. You trap your personal wealth in cardboard boxes sitting in a warehouse for months. Wealthy operators avoid paying in advance for their inventory. Overseas manufacturers hand over the physical products on specific payment schedules like 30, 60, or 90 days. You take physical possession of the pens on day 1 and send the wire transfer months after delivery. The factory acts as your personal lender, using the physical goods as the loan itself. Run the core calculation on this specific scenario. You move the merchandise to retail buyers before the manufacturer demands payment. You collect revenue from the stores, forward the required amount to the factory, and pocket the remaining profit. Your personal capital contribution sits at absolute zero. You command a massive 40-foot shipping container of goods without spending a single dime of your own money. You achieve infinite financial leverage because you divide your total returns by 0 personal dollars invested. Your profit margin per unit stays small. Multiplying that small margin by infinite leverage creates massive returns on your personal investment. You build a lucrative career in sales because of this math. Successful merchants prioritize favorable payment schedules over cash reserves. You can execute this exact strategy today without booking a flight to an overseas manufacturing plant. Entrepreneurs use trade credit whenever they sell physical goods before paying for them. You might use a 0% introductory credit card to finance your retail stock. A local wholesale vendor might grant you a 30-day window to settle outstanding invoices. A client might hand you a cash deposit to cover raw materials before you start the work. These examples use the identical financial framework on a smaller scale. The final section of our guide covers the most practical application of this concept. Real estate investing demonstrates this exact practical application. Most finance creators miscalculate the numbers for this second strategy. We will calculate the exact figures using a specific scenario. You locate a neglected house with a $500,000 asking price. The peeling paint, overgrown yard, and outdated plumbing keep retail buyers away and force the low price. You pay a 20% down payment of $100,000. A bank provides a $400,000 mortgage for the remaining balance. You spend $50,000 renovating the building with a new architectural roof, fresh drywall, luxury vinyl plank flooring, and modern stainless steel kitchen appliances. Your total cash investment now equals $150,000 resting inside the physical structure. The renovated house attracts eager buyers and jumps to a $700,000 market value. You visit the bank to refinance and secure a new loan for 80% of the updated value. That 80% equals a massive $560,000 check. You pay off the original $400,000 mortgage with these fresh funds. Bank hands you the remaining $160,000 in cash to use however you please. Other creators subtract the $50,000 renovation cost from the $160,000 withdrawal to claim a $110,000 profit. They misunderstand the transaction. You invested $150,000 of personal cash and withdrew $160,000. You recovered your entire initial investment plus a small bonus. You also retain ownership of a $700,000 asset containing $140,000 of equity to generate monthly rental income. Calculate the final metric for your personal cash remaining in the transaction. The balance sits at absolute zero. You withdrew every single dollar from the deal. Your return on investment divides your profit by $0 of invested capital. Math teachers warn students about dividing by zero because the calculation breaks standard equations. In real estate, dividing by zero yields an infinite return on your capital. Investors chase this strategy to recycle their down payment while retaining the physical asset. We focus on the arithmetic here and avoid selling you a dream. Your new $560,000 loan dwarfs the original $400,000 debt. Current 6% interest rates multiply that larger principal into a massive monthly payment. The bank also charges 2 to 5% in closing costs to process the refinance paperwork, adding thousands in upfront fees. Rental income must exceed this larger mortgage payment to make the deal financially viable. You need tenants paying enough rent to cover the principal, the interest, the property taxes, and the insurance premiums. Finding a property generating positive cash flow constitutes the actual challenge. Gurus ignore this difficult step in their expensive courses. Average individuals execute this exact playbook without billionaire bank accounts. Success requires patience and a sharp eye for distressed properties. Finding distressed properties sets the foundation for wealth. The next phase elevates your approach to the exact method billionaires use to pay near-zero income tax. Lawmakers bypass secret loopholes in the tax code for these individuals. They combine three standard regulations into a single framework. We call this framework buy, borrow, die. The first phase requires purchasing appreciating assets. You acquire stocks, a private company, or property. Your net worth climbs on paper. The government ignores those paper gains. The government demands payment when you exchange an asset for cash. Wealthy individuals follow a strict mandate to avoid selling. Selling an asset creates a taxable event. You need cash to cover daily expenses and fund your lifestyle. Phase 2 solves this cash shortage. You visit a bank or brokerage firm and secure a loan using your investment portfolio as collateral. Financial institutions offer this specific product under the name securities-backed line of credit. You hand over your stock shares to secure the debt, and the bank hands you cash. Current interest rates for these loans sit between 5.5% and 6.5%. The largest portfolios secure the lowest rates. Compare those borrowing costs to the 7% baseline growth rate. Your investments grow at 7% while the loan costs 6%. You maintain a positive spread without selling a single share. You pay zero capital gains tax. A direct sale would trigger a long-term capital gains rate reaching 23.8% after adding the net investment income tax. Paying 6% interest to avoid a 24% tax bill forms the core objective. You rent money at 6% to bypass a 24% government fee. Phase 3 arrives at the end of your life. Current tax laws allow your heirs to inherit your assets at a stepped-up basis. This provision erases the lifetime of untaxed paper gains. The government resets your cost basis to the current market value on the day you pass away. Your children receive the stock, and your estate pays off the bank loan using other funds. The decades of untaxed growth remain untaxed across generations. Federal analysts calculate this specific rule deprives the Treasury of $41 billion each year. The government fails to catch this wealth with the estate tax. The estate tax exemption reaches $15 million per individual and $30 million for a married couple in the year 2026. The final phase avoids the estate tax for almost every participant in this system. You buy assets, refuse to sell, borrow against the value, live without paying income tax, pass away, and watch the taxable gains disappear. The system operates like a well-oiled machine. You lack the massive pile of appreciated assets required to secure a securities-backed line of credit today. A scaled-down version of this exact concept will become available for your own use in the near future. Understanding the mechanics of borrowing against a portfolio reveals the underlying engine of the previous strategy. This strategy carries a severe risk. Banks cap loans below the total dollar amount in your account. Lenders advance 50 to 95% of your total portfolio value based on your specific holdings. The bank tracks those holdings every trading day. Falling stock prices reduce the value of your collateral. The lender then demands immediate repayment in the form of extra cash or additional stock. The bank will sell your assets without permission to cover the debt if you fail to provide more collateral. Financial professionals call this event a margin call. Experiencing a margin call transforms financial leverage from a useful instrument into a dangerous snare. Using borrowed money multiplies your baseline 7% growth rate in both directions. A positive spread builds substantial wealth. A negative spread creates catastrophic losses. One specific variation of this borrowing strategy guarantees absolute financial ruin. Wall Street calls this particular guardrail short selling. Investors reverse the standard borrowing process. A trader borrows a stock share instead of cash. The trader sells that share to a buyer. You wait for the price to drop. A lower price lets you repurchase the share at a discount and keep the cash. You profit from a failing business. I refuse to dedicate a full segment to this tactic because the risk profile destroys amateurs. A traditional stock buyer faces a strict limit. The stock drops to zero and the buyer loses their cash. Short sellers face a different reality. Stock prices lack a ceiling. A rising share price forces the short seller to cover mounting losses without an upper boundary. The broker demands the share back. The seller must purchase that share at the inflated price to close the loan. This debt variation bankrupts overconfident traders. The basic borrowing equation remains intact. The financial spread plunges into infinite negative territory. You possess the knowledge to spot this trap and avoid it. You bring these financial concepts back to everyday life with the most actionable trick on the entire list. You execute a small-scale version of the trade credit float from our previous section. A major credit card company hands you thousands of dollars in cash at 0% interest, instead of a manufacturing factory handing you boxes of pens to sell. Credit card issuers offer 0% interest for 18 to 21 months through current balance transfer promotions. A few select banks extend that promotional period to a full 24 months. Banks charge a 3 to 5% upfront transfer fee to process the transaction and move the money. You pay that single upfront fee as the only catch in the entire agreement. You rent a large sum of cash for near 3% total across 2 full years. Generating a 3% return over 2 years sets a low bar for your investments. You keep any profit you generate above that 3% threshold as direct profit in your checking account. The most reliable and boring application involves moving expensive consumer debt. You take a large 5-figure balance sitting on an old card charging 24% interest and shift the entire amount to a brand new card charging 0%. You erase a high 24% interest rate while paying 3% for the privilege. You lock in a guaranteed 21% return that very few traditional stock or bond investments provide in the current market. You use this mathematical process to copy the strategy the importer used in our first example. You borrow capital at a low rate, deploy the funds to generate yield, and pocket the difference. The sole distinction between your personal bank account and the pen seller's global operation involves the total dollar amount. This sixth strategy connects to that dollar gap. Every person here can start this specific process today. Remember the core mathematical spread concept. Your financial spread equals what your money earns minus what your money costs. Average individuals focus their energy on chasing higher investment returns. Wealthy individuals fixate on lowering those specific borrowing expenses. Banks and lenders negotiate your baseline interest rate. You drop that baseline rate by a single percentage point. That specific fraction increases your profit margin. You stack multiple layers of financial advantage. Above any other factor, your FICO rating determines your borrowing costs. The current national average credit score sits at 715. Upgrading a mediocre rating to a stellar 1 shaves multiple percentage points from your interest rate. You secure these lower rates across mortgages, auto loans, and commercial credit lines. Those tiny fractions multiply across every loan you take for the rest of your life. You keep tens or hundreds of thousands of dollars. Affluent borrowers skip exclusive private banks, proving themselves cheap to lend to secures cheaper capital. Raising your specific rating remains within your power. You control this specific metric. Stock selection involves outside variables. Building a flawless borrowing history relies on your personal habits. You saw several tactics you can execute on your own, and we covered them throughout our discussion. I want you to apply the core calculation to your personal finances this week. You tackle your borrowing costs to secure a quick victory without spending a dime. You run a simple credit check to discover your current borrowing price. You increase your score by a single point and decrease the interest charged on all future loans. You lower the rent on every single dollar you will borrow. You use this sixth strategy to guarantee financial improvement and secure pure upside. You use 0% balance transfers as your most effective available tool. You carry a high-interest credit card balance and place yourself on the losing side of our core metric. You act as a factory providing a 24% loan to the bank, but we reverse this dynamic. You transfer the outstanding amount to a 0% promotional card. You pay a 3% transfer fee and avoid a 24% annual rate. You convert a negative spread into a positive spread. You possess the ability to execute this transfer this afternoon and stop funding the bank. You collect early payments to benefit your business or your sales operation. You secure customer deposits before purchasing raw materials. Smart entrepreneurs utilize the 30-day payment window their vendors provide. You get paid before you have to pay your own bills. You reduce your personal cash contribution to each transaction while increasing your core metric. You shrink your personal capital requirement with each successful negotiation because you divide the total profit by a smaller personal investment. You calculate your personal leverage ratio. You determine the total capital you control for each personal dollar invested. You compare returns against borrowing costs to reveal your specific metric. A wealthy executive utilizes a massive corporate credit line and performs the same math as you executing a simple balance transfer. You perform identical arithmetic across different wealth levels. You change the total dollar amounts and the specific application. You point the exact same formula in your preferred direction to build wealth. You treat borrowed money like rented capital. You ask the ultimate financial question: do you generate returns exceeding your interest payments from your investments? You position your returns above your borrowing costs and transform loans from personal liabilities into profitable assets you own. Lower-income individuals rush to eliminate their balances to escape the burden. Wealthy individuals calculate their interest spread and maximize their controlled capital. Both groups access identical banking products and face identical interest rates. You understand the single calculation separating these two financial approaches.